I'd like to welcome you all to today's webinar, M&A and Valuation Insights, How Contact Center Companies Are Being Valued in the Market. PACE is partnered with Corporate Advisory Solutions to bring you this informative and educational webinar. As we do prepare to start the webinar, we want to remind you of a few housekeeping items. All participant lines are on mute right now. If you'd like to ask a question, you can do so via the chat box on the right-hand side of your screen. We will get to as many questions as possible during our last 10 to 15 minutes of our time today. This webinar is being recorded, and a recording of the webinar will be available on the PACE website in just a few days. If you would like to receive the slides from today's webinar, please send me an email at chris.haerich@paceassociation.org, and I'll be happy to send them to you. Without further ado, I'd like to introduce the speakers for today's webinar. First, we have Michael Lamm, and Michael is the founding partner of Corporate Advisory Solutions, a respected and fast-growing merchant bank that supports a select group of clients with offices in Philadelphia and Washington, D.C. Michael has completed over 100 M&A engagements in the outsourced business services arena and leads his deal team on M&A engagements, compliance and regulatory assessments, valuation and expert witness litigation matters, while also charting the firm's corporate direction and strategic growth plan. Michael is actively involved in leading industry associations and a frequent guest speaker and presenter at industry conferences and events. Our next speaker is Mr. Mark Russell. As a co-founder and managing partner of Corporate Advisory Solutions, Mark manages all the aspects of the firm's operation and transaction advisory engagements while working from the firm's Chevy Chase, Maryland office. In addition to helping clients prepare for a business for sale, he works with clients who wish to make an acquisition to either grow or diversify a business. Drawing upon his many years of experience, Mark also provides valuation and strategic consulting services to client companies. Mark holds a Series 78, 82, and 63 license registration as a registered representative of Still Point Capital, LLC, and through that, he also conducts security transactions, including capital raises and M&A engagements. Michael and Mark, I'm going to go ahead and turn the floor over to you now.
Great, Chris. Thanks again. This is Michael talking. Thanks, everybody, for joining today. We're going to run through a few slides here on our different topics that we're going to cover today. So Mark and I will be tag teaming it as we kind of go through things. As you have questions, we're going to try to leave as much time as we can toward the end to address questions that come up from the audience, so feel free to ask away. If we can't get to them all, we will certainly answer them offline. So again, don't feel shy about asking any questions. Just a quick disclaimer here, as you're seeing on your screen. This is our corporate advisory is providing this information to you. Please note that we are not here providing legal or tax advice as we go through this. So this is just a general overview, and please utilize it and think about it from that perspective as you're going through, as you see the slides and review the slides after the fact. So today we're going to go through a few topics, kind of the overview and trends in the contact center industry, some of the technology disruptors that we're seeing happening, what's driving value, some noteworthy deals, and then the ultimate kind of punchline, which is how companies are trading in the market, what's driving those multiples, and then we're going to, as I said, go through some Q&A. So just to keep going here, The first slide we're going to cover, just a quick overview, which many of you guys are already familiar with, is just the size of the market. Right now we're kind of seeing when you lump in just the traditional telemarketing, inbound, outbound services, you're looking at roughly $28 billion in kind of overall size of the market. The market is growing slowly as predicted, but it's, roughly we're seeing about 2.7, 2.8% growth in the industry. A lot of that is being driven by omni-channel and technology change that we're going to get to later in the presentation. As is pretty usual or pretty typical in industries like this, there's a few players that really dominate the market. Several of them are publicly traded, both in the U.S. as well as internationally. But the market is certainly fairly diverse, with a majority of that work still falling into customer care, inbound and outbound, tech support, traditional telemarketing, which has been shrinking over time, as well as some components of debt collection. Mark, anything to add on the overall size and kind of trends in the market related to the contact center area?
Yeah, sure. Just real quick. I totally echo what Michael just said. We're also noting that there are some areas that continue to be very price sensitive, driven by a client's desire to have either a combination of onshore and nearshore or offshore staff services, or it's just a very heavily commoditized or competitive environment. We're seeing that more on the simplistic interactions, and whether it be on the inbound or the outbound side of the calling process. The debt collection component of the pie chart, just so everybody understands, is not an accurate deflection or reflection of that market space. That market in its entirety is actually close to $12 billion of revenue, but for purposes of this, we leverage the IBIS World information, and if you want to talk further about that particular market segment or any of the others, we'd be more than happy to do that at the end of the program here.
So thanks, Mark. So some of the other key trends that we're seeing right now that's really challenging the market is the low levels of unemployment that we're seeing across this country is not helping staffing. It's making it very challenging in the market to hire agents, and as a result of that, we're certainly seeing a push again, and it goes up and down. Every few years there seems to be a shift where folks are, nearshore, offshore, whether it's in vogue or not. It's now becoming more in vogue again because of some of the labor shortage issues that are going on in the market. So we're seeing a lot more delivery or interest in having the delivery handled offshore or nearshore. Nearshore is definitely picking up a lot more steam. Places like the Caribbean, Central and South America, Mexico are certainly hotbeds. Many companies, many of our clients have begun to move in that direction, and not only for Spanish speaking, but for lower cost labor too. Other key trends that we're watching and monitoring closely is just all of the call blocking and regulatory shifts that are going on related to that. That's obviously posing issues where it's also pushing for less phone-intensive activities, much more technology, chat, text-based communication channels, whether that's a fintech that's driving it or a large telco. They're all looking to interface with multi-pronged communication channels, and if you're not doing that, I think it's certainly going to become a challenge to continue to operate in the market without having those technologies and capabilities internally to offer to the clients. So from that end of it, we really think that over the next few years, we're going to see a lot more technology. The buzzword that everyone talks about every single day is artificial intelligence. It means different things to different people, but I will tell you the predictive side of that and the data and analytics piece of it is growing tremendously, where the data is going to be provided to the contact centers or in tandem with that to help those businesses be even more efficient and effective with the consumers or businesses that they're interfacing with. So we're starting to see that conversion happen in pretty much every vertical area that the contact center market plays in today. Mark, anything else to add there before we go to the next slide?
Yeah, just a couple quick points. Speech analytics and data analytics are definitely at the forefront of the artificial intelligence, what I'll call evolution here in the CRM process. But hosted IVR is also an area where certain contact center companies are starting to leverage real gains there in pretty much having an end-to-end solution where either a consumer or possibly even a business is dialing in and having a conversation literally with the computer from start to finish. Now, some of the stuff is still in beta test mode, and we do realize that it hasn't fully been rolled out to that ability, and some folks claim they already have it, but when you take into account the regulatory compliance requirements and things of that nature, we're actually starting to see some real progress in that area to a point where Michael and I feel pretty confidently that in the next 3 to 5 years, while revenues may continue to grow, you may actually start to see a decrease in the number of staff, particularly in the U.S., dedicated to this industry. So that's something we're keeping a close eye on as well.
Yeah, the other point I would note here that we're watching really closely, because all of this technology leads to data security related issues and cyber related liabilities, that is an item that we're watching pretty closely too, because as all of these new technologies are deployed onshore and offshore, we're bound to have data security issues. We see them every day. They come out, whether it's, the Capital One or any of the other breaches that have occurred in the past 6 to 12 months. We're expecting we're going to see more of that, and as a result, we're going to see a lot more consulting data security companies that are going to be trying to focus on making sure that the third parties that are getting the outsourcing work from the large clients, Fortune 500, Fortune 1000, are really locked down from a data perspective. And if they don't have those levels of compliance, I doubt very highly that they're going to be able to service that Fortune 500 pool, specifically the financial services players. But we'll get into that a little bit more as we talk about M&A value drivers. So again, on the technology disruptors, these are just a few of the key things that we are seeing that are out there that we referenced earlier. These are items that, again, nothing's new here. I think that the chat bots and some of these omni-channel communication strategies is really where things are going. And so the contact centers that are becoming more like technology BPO companies, whether they're doing it on a proprietary basis with their own or they're using off-the-shelf technology, is certainly is kind of a key driver in the marketplace right now. And from a value perspective, it certainly matters. But I do think when it's all said and done, the technology is only one piece to this equation. It's the data that's going to be there, that's going to lead that client to make decisions on what product or service to provide to the consumer or to the business, but also on what not to provide or how to provide it. So we're seeing a lot of change happening there, which is obviously going to help over time drive profitability, but it's going to take some time to get there. Mark, anything else to add on technology before we go to M&A value drivers?
Nope, I'm good.
Okay. So on the M&A value drivers, we wanted just to kind of give you the Cliff Notes version of some of the key things that we see when strategic buyers are looking at areas of the industry. So when we think about a strategic buyer, they may be a larger BPO or contact center company that's looking to enter the market or expand their presence in a particular area or geography. And so when they're looking at that, their number one focus typically is to see where the client base and the sales pipeline is. The client base and the sales pipeline will typically drive their level of interest. Areas right now that are getting a lot of interest are niche markets, whether it's fintech or certain food services markets. There's a lot of different areas that some of the larger multinational global CRM BPO companies are where they're looking to go, and they're looking for niche markets that are becoming in areas that they're not in today that they could expand into and where they can get a lot of cost synergy. So so those are some of the key things. Obviously, when it comes to areas like financial services, traditional financial services, or telco, we continue to hear from different players, more strategics, of some of the challenges and the commoditization of those markets, which is why some of these more niche areas have become more attractive, whether it's, again, something that is in dealing in student loans or student servicing or everything related to hospitality. Those areas are getting more interest than your traditional markets today. Mark, anything else on value drivers?
Yeah, well, for the strategic buyers in particular, their motivation is to either grow market share within their existing areas of focus or enter into new markets / service lines. Okay, that's what they want to do. So depending on the fit, the question always becomes, what do they need post-transaction from the seller? And sellers need to think about that because if the owners in particular of the selling entity just want to get out after a transitional period, then they need to understand what exactly the strategic buyer's interest may be. If it's simply to bring them in and lay their selling entity over an existing infrastructure and therefore get cost synergies with new client business, then that's a straightforward answer. But if they're really helping the strategic buyer get into a new service line, then the sellers are going to have to understand and appreciate that they're probably going to have to stick around a little bit longer in order to effect a smooth transition. So strategic buyers are very valuable to a seller so long as everyone understands each other's interests and the time frames associated with it.
Yeah, it's this common misnomer that is out there in the market that these businesses will just transition themselves. They need, in any type of transaction, for it to be effective in this type of a market, these clients are going to be heavily reliant on where that relationship is. Yes, performance, quality assurance, compliance, all those things matter, but there's still a relationship. So there's sales, business development, people that are managing those relationships will likely need, if not be required, to continue with that strategic buyer post-sale. And this is sometimes, issues around culture, strategic fit, everything else to make sure that the people that are there with those client relationships move over. And so there's a lot of discussion typically in deals that relate in this particular area of the industry on how that transition will occur and making sure that it will be seamless. So again, those are some key things that will be a key item that will drive value, good or bad, in today's environment. So on the next slide, we're going to talk about financial buyers. When we talk about financial buyers, this could mean anything from a private equity firm, a high net worth individual, a family fund that's looking to invest in and acquire a platform in the industry. And typically, when they are looking at transactions, they are looking for consistent top and bottom line growth, a 5-year growth plan with assumptions, ideally, if it's available, multi-year contracts with certain clients with performance measurements. Those are all things that will drive value in the eyes of a financial buyer. But as we can all appreciate, one of the challenges is client concentration. We see this a lot where there's 1, 2, or 3 clients that make up a bulk of the revenue. And those businesses can transact, but typically there will be more structure, earnouts, a note, retained equity, especially under the financial buyer scenario, to make a deal happen. So we frequently will see when we're bringing deals out to the street, we have to evaluate that client concentration item along with some of the other items that are on this particular slide. But that client concentration level will also drive whether it may be a better deal for a strategic or a financial player. Mark?
Yeah. In today's market, financial buyers care very much about everything listed here on the slide. But in general, what they want to see, number one, is they want to see a company that when they buy into it, they feel extremely confident they can partner with the senior leadership team to help that business either continue on its existing growth trajectory or establish a more aggressive growth trajectory while managing the risks of that growth, whether it be compliance risk, loss of clients, having to make very significant capital investments for either new technologies or new facilities or whatever the case may be. And they want to be able to effect their plan, again, within a, broadly speaking, 3 to 7 year horizon. That's a general timeline for financial buyers. Now, we've seen and we've completed deals with private equity firms, hedge funds, individuals, angel funds, whatever the case may be. So we've done a lot of different deals in a lot of different scenarios, and there's always exceptions to the rule. But what financial buyers are most interested in today in the contact center space are those companies that have some way of differentiating themselves, ideally through the use of artificial intelligence, technology changes where somebody as a competitor may be doing things more manually or less profitably, and there's a way to, again, expedite growth and profitability through implementations of new technologies or whatever the case may be. That's very exciting to financial buyers. And if you have that type of a company or you are working with that type of a company, we can tell you wholeheartedly that they would be very well received by the marketplace. Financial buyers, certain ones, will take on distressed or challenging situations, but the company, number one, has to be large enough for them to be able to work with it and turn it into something profitable and growing down the road. or the financial buyer will want to marry that existing company with another company, and through the synergies of consolidation, achieve their business objectives. But that's the mindset, and that's the way financial buyers think, and it is different than your traditional strategic buyer mentality. We always recommend that if companies are going to market and you're of a certain size, generating $3 million or more of adjusted earnings, that you should try to have both types of buyers in discussions, because they bring something different to the table, and you never know which type can be the best. But in a nutshell, what you see on the slide is of importance. If you have further questions at the end of this presentation, we're more than happy to get into it. But financial buyers have been very active in this space in the last couple of years, and we'll talk about that in a moment.
Yeah, so just to continue on, these are just some of the noteworthy deals in the space. As Mark just said, we're starting to see more private equity groups. Years ago, this industry was specifically dominated only by strategic and industry acquirers. That's changing. You're going to see that change even more so with the technology disruptors that we talked about earlier. So expect to see, if we were to do this presentation a year or so from now, I think you're going to see a lot more private equity transactions on this list as noteworthy. So we're excited to see that. I think there's a lot of really great management teams that are thinking differently about these technology shifts, and are going to build some pretty interesting businesses over the next 5 to 10 years that private equity is going to want to get behind. But again, as we said earlier, a lot of the deals in the past couple of years have been dominated by strategics, private equity-backed strategics that have grown and then ultimately exited the marketplace. So on this slide, we're going to talk a little bit about just overall multiples and how companies are being valued today. Now, I want to disclaim this and say this is, we're just giving some general guidance. Every business has different value drivers and detractors, client concentration, technology, other things that will drive these multiples up or down. But we wanted to kind of layer in some general kind of call center, contact center multiples, service business type multiples that we're seeing on the street right now. And so we broke it out into different categories, so you could kind of look at it from a revenue perspective, annual revenue. For example, as you go up the food chain in revenue, the multiples, assuming there are those value drivers that we talked about earlier exist, those multiples can certainly move up into that 6 to 9 times range. However, for kind of the plain vanilla call center company that's doing inbound work that may be heavily concentrated, that may be 10, 20 million of revenue, you can see that these multiples could be anywhere as low as 3 times to upwards of 7 times. In these multiples, the other thing I would say too is that we're not, we can give you a different vantage point on buying distressed companies that are not profitable, that have issues or hair on them or skeletons in the closet. They're going to be approached much differently than what's on this page. So it's going to look a bit different in terms of how that approach is taken. Mark, did you want to talk a little bit about kind of just the calculation and how we view kind of adjusted EBITDA for those that may not be familiar with that terminology?
Sure. So we obviously don't have a level of understanding of the folks listening in as to whether or not they have a background here in valuing businesses or seeing deals or whatever the case may be. But the general formula for coming up with market valuation of contact center companies is a multiple of what we call adjusted EBITDA. And EBITDA, as an accounting term, is simply the earnings of the business prior to taking into account interest expense, income taxes, depreciation, and amortization expense. The adjusted part of that equation are what we call non-recurring expense items, which can include a number of things: one-off expenses, some level of perhaps expenses that might be recognized as either personal or non-business related for whatever reason of the owners who will not be there post-transaction, or whatever is mutually agreed to. And to Michael's earlier point, the multiples of adjusted EBITDA that we're showing here are sort of averages based on, a culmination of deals that we are aware of that have closed, but there have always been exceptions to the rule. So, we've been involved with deals, and we've seen deals where the company may have, $6 million of revenue and 20% margins and growing at a rate of 15 to 20% a year, trading for 6 times or possibly a little bit more. And we've seen companies with 30 million of revenue and not profitable but flat trade for, some hybrid percentage of revenue because it was a turnaround / distress situation. So there's always going to be exceptions to the rule. The general thought, though, is if you are involved with or own a company that is outperforming the market rate of growth, and by the market rate, I would say if your company is growing faster than, call it 10% a year, and you have stronger than a 10% margin, you're not only going to be considered attractive, but you're going to be considered a premium company in today's marketplace, subject to your level of client concentration and whatever other dynamics may exist within the business. So as a premium company, you would be expected to get a premium value. And likewise, if you're only growing at a level of 5% or less a year and your margin is 5% or less, then you're going to be considered, a less premium of a company, and it just depends on who the buyer is and what the relationship would look like in terms of synergies and consolidation opportunities as to where the multiple would come out.
Mark, the other thing to add there, just so everyone's clear, like on a one-time expense, an example of a one-time expense that may flow through the income statement is, let's say you had a flood in your operation. It happened once in 20 years, and there was a lot of expense cleanup for that. Those are the types of things we're thinking about. When it comes to ramp up of clients and or ramp up of staffing for clients, those are more challenging one-time expenses to get a buyer comfortable with. So I just wanted to make sure everyone was clear on kind of how we're viewing kind of one-time expenses versus something that is different than that. So anyway, I just wanted to throw that point out there as well. The other thing I would say before we move on to some Q&A is around whether you have offshore or nearshore capability. It does not mean if you don't have offshore or nearshore capability, it doesn't mean your business is going to have a value detractor. If you're all onshore and you're in a particular market, there may be a perfectly good reason for that, and your margins have continued to grow if you're in certain parts of this country. So I want everyone to hear that, yes, offshore, nearshore is a critical piece in a lot of cases. There are exceptions to the rule.
Yep. And Michael, before we go on to the Q&A, I just want to make one more point, and that is what you're seeing on this slide here is what is used to calculate enterprise value, but the deal structure component is also going to be heavily negotiated depending on a lot of factors, one being the client concentration, the other being the growth rate, and quite frankly, the level of competitiveness in a process, if you are in a process. So it's not unheard of that certain buyers would pay 100% cash at closing, but I can tell you from experience that it's pretty rare. There's a host of different things. There's escrows that are used in most deals. There's earnouts, seller's notes, perhaps retained equity by executives and or owners if a financial buyer is involved. There could be a host of different things that create some level of structure in getting a deal done. And that part of the negotiation is definitely more art than science. Yes, there are data points, but at the end of the day, it's being brought down to not what the market is willing to bear, but at that particular junction in a deal process, it's what a specific seller and buyer are willing to agree to. So if that generates questions, we can certainly dive into that.
Let me just, sorry. We're going to take, before we get to, well, Mark, we can summarize our, the webinar right now, or we can take some questions that relate to some of the topics that we just covered. There's a couple of questions that have come through that I can, being Mark, you and I aren't together, I could read off.
Sure.
If we want to go there.
Yeah, why don't we start with the ones that have already come in, and then we can ask the audience at large if there's any additional questions.
Very good. One question that just came in from one of the folks was around how long are deals taking today to close in the contact center industry, Mark? Are deals getting done in 30 days, 60 days? What's the general timeline today?
Do you want me to kick off the answer of that?
Yeah, why don't you take it, and then I'll jump in.
All right, fine. Well, putting on my consulting hat for a second, it depends. It depends on what kind of a deal it is. If it's a transitional issue or a distress situation, it could very likely get done in 30 to 60 days. Most of the time, you are looking at a longer time horizon of 3 to 6 months. So, and that's after the either the representative who is advising on the deal or the company themselves to put together initial what we call marketing materials, and also gone through the process of just getting everybody ready on the seller side to be ready for a deal process. And when you're looking at a 3 to 6 month window, the first half of that is actually going through the marketing process of contacting or interacting with the buyers, getting confidentiality agreements executed, sharing this initial information, having your conference calls and meetings, and getting enough information out the door so you can get realistic offers from the buyer, either as an indicative offer or what we call a letter of intent. The goal of this whole initial process is generally to hone in on one buyer who will then be given the opportunity to conduct confirmatory due diligence, which that process in and of itself can take anywhere from typically 30 to 60 days. It could be longer depending on the complexities associated with the deal. But generally 30 to 60 days is the appropriate time frame, and buyers will usually require a exclusivity during that period of time, meaning the seller is obligated to work only with that buyer while they go through the process. Now, the exclusivity is an important piece for the buyer because generally speaking, they're spending a lot of time, resources, and money to get through confirmatory due diligence. And the term a lot can range, and I'm not even going to venture, it could be on the low end, 30 to 50 grand to a high end of $200,000 to $300,000, depending again on how complex and involved the deal may be.
Great, Mark.
And so I'm sorry, go for it.
No. I just want to make sure we're cognizant of time. Keep going. There's a few other questions that come in.
Oh, yeah. No. I just wanted to end with, once you get through confirmatory due diligence, then you've got to negotiate and agree on terms in what's called the purchase agreement and in order to consummate the deal. So if people have further questions about the process or the steps, we're more than happy to try to address them as we can here.
The next question that came through was around what buyers are looking for in terms of data security, looking from a diligence perspective. Data security is a big topic right now in this space, and also just overall when you look at the market landscape that we talked about earlier, especially if you're dealing with consumer information, PII, that there is more focus on that that we've seen in due diligence than ever before, and that's been going on for the past 2 or 3 years. PCI, all of the ISOs, making sure that your process and the data is locked down. There's been a couple of data breaches that involved companies in the space or adjacent to the space where there was data, credit card data that was stored and taken out of the company's systems, and they had an offshore capability. So there was some issues with the connectivity in terms of how the data was being secured, which is how supposedly someone may have gotten in and taken a lot of the credit card data out of the company's systems. These are things that matter. Buyers are reading about it just like we are in the news, and it comes up in diligence. And so the more that you can demonstrate that you've made those appropriate investments in data security, the better off you'll be in terms of maximizing transaction value. Another question mark that came in was around the size of a company for them to attract private equity or a family office. Did you want to comment on that?
Yeah, more than happy to. Look, with traditional private equity, they typically want to see on the very low end $3 to $5 million in EBITDA, but ideally north of $5 million of adjusted EBITDA. And the primary reason for those hurdles is driven by their lenders. In order for a lender to want to support a deal, they want to see at least that level of earnings that they can lend against, and they want to also understand the stability and growth potential going forward. Again, always exceptions to the rule. Family funds can get smaller than that because they don't necessarily have as heavy of a reliance on outside lenders. And if they do, because of their type of patient capital, they can, again, typically put more equity in or whatever is necessary in order to consummate a deal. Michael, do you want to add to that?
No, I think that was good, Mark. I'm good there. The last question that came in was just around the overall process of selling or buying a company in the space, and I would just answer it this way, and I'm happy to have any follow-ups on this offline. The more preparation that can be done before selling the business is really critical around financial, ops, and IT. And what I mean by that is just making sure that, number one, your financial controls are in order. I can't tell you how many times Mark and I battle through this, and it doesn't necessarily mean that the client just needs to have audited financial statements to sell the business. We sell companies every day of the week that don't have audited financial statements. Does it make life easier? Absolutely. But getting those controls in place, whether you've got a compilation or a review, is really important, and it drives the ability for an advisor, an attorney, an accountant, whoever it is, or somebody like us, to help them through a transaction. So I would tell you that is certainly critical. In terms of buying a company, I would tell you one of the biggest tips I have there is obviously to make sure that you've got the time and the team of people around you that have acquired companies before, so you can avoid making a lot of rookie mistakes, and making sure that you're able to really understand the operational side of whatever new market you're buying into. Because if you're a financial services contact center business and you're looking to go into doing work in the utility market, world of difference, things that need to be evaluated and looked at are different. So having people around you that have had experience buying companies and integrating them becomes a very important and critical piece to getting a deal done. Mark, do you have anything else to add on that before we conclude?
Privately owned companies, the owners of those businesses tend to want to restrict who knows about a process or even an interest level to sell to the owners, and that's fine, and certainly something that we've seen quite a bit of. The challenge becomes how to access and manage information through a process. And the last thing in the world you want is if you're going to start talking. I'm sorry, I was getting some feedback there. If the last thing in the world that a seller wants is to get into a process, be talking to multiple buyers, and then all of a sudden everything gets slowed down because they're having a hard time responding to questions, providing additional level of information. So the more that the seller can be prepared for that process in advance of starting it, just the better off it'll be.
Hey, Michael and Mark, can I ask one question? I know you kind of touched on it, but as you were, because, in the contact center space right now, or the customer engagement space, there is an explosion of technology. Does it help your valuation or your chances if you have the latest and greatest technology? And, or to take it another route, if you have had maybe known compliance issues where you were investigated either by a federal or state governing body, does that affect your valuation?
Michael, why don't you go for it first?
Yeah, Chris, great questions. Let me start on the federal state investigation side. We've dealt with a lot of companies that have undergone that, and it does not mean that they're not saleable. Every situation's a bit different in terms of how that was handled and what requirements have been put around them and over what period of time. So those situations need to be evaluated. It doesn't mean a transaction cannot occur. If it's underway during a sale of a process, it certainly could cause a problem because obviously you don't have findings yet. So the key there is really to understand what the issues are, figure out what the exposure is, and how a structure or an escrow can be dealt with there, or an asset type transaction to avoid those types of legal liabilities transferring over to the buyer. But it doesn't mean that a deal cannot be completed as a result of that. It just depends on the situation. In terms of your second question about technology, there's really, when you look at it, there's off-the-shelf technology, and then there's folks that are developing their own proprietary technologies. And when you think about proprietary technology, there are groups in our market that want to commercialize that and use that as a value enhancer. They're using it internally for their own contact center, and they're selling it to others. Different valuation approach and process for that piece of the business as it's ramping and growing on the technology side. But right now, because there's so much unknown who the winners and losers of this technology race will be, it certainly is something that is being diligenced in terms of its effectiveness and margin enhancement. So we're studying that too with buyers to really help determine how best to position the company for an eventual exit, because that technology could have a significant short-term cost, but a major long-term benefit, but it hasn't been shown yet. And that's something that needs to be thought about from a financial perspective as it relates to projections and the growth plan. So that's where it starts coming into play, because it tends to be more of a best guess than something that's known, because of all the change that's happening every single month, week that goes by in this industry.
Fantastic. Thank you for answering that.
So
go ahead.
Yeah,
no, go right ahead.
Chris, do you have any other questions that have come through? Those are the ones that we had that came through. Anything else on your end?
No, I don't have anything else on my end. So with that being said, I'd like to thank Michael, you, and Mark, you, for your informative webinar today. As I said, the recording of the webinar will be available on the website in just a couple of days. And just as a reminder for everybody, we're having our Contact Center Summit in Denver on October 29th and in Princeton, New Jersey on November 14th. And we're planning ahead already for our National Convention Expo that'll be held April 5th through the 7th at the Omni Resort and Media Island. You can find out details on all of these events by going to our website. We hope to see you very soon at another PACE webinar, national, regional, or chapter event. I thank you all for your time, Michael and Mark, you as well, and I hope you all have a great rest of your day. Bye now.